It's an urgent warning. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it finally happened, and this is something the political elite said could not and would not happen, and yet remain in complete denial despite confirming evidence today that this is now the beginning stages of something that is going to devastate the U.S. economy. And as you're about to see, it's outright terrifying because nobody said this would happen. And yet it's about to send a lot of Americans to the unemployment line. Now let's head over to Bloomberg, where I need you to understand today's non-farm payroll report, because once you understand that, everything will make perfect sense of what is coming as the U.S. payroll growth slows and jobless rate now ticks up to 4.1%. And this is just the beginning of the things the political elite said would not happen. Recently, Fed Chair Jerome Powell said the unemployment rate would peak at 4%. Now it's at 4.1%, and we're going to make the case of why this is headed even higher, but that's not what's really outright terrifying. Let's take a look, because the non-farm payrolls rose by 206,000, and job growth in the prior 2 months was revised down by 111,000 according to Bureau of Labor Statistics. So already on the forefront, we can put into question the 206,000 number, knowing it's likely going to be revised lower here in the coming months. And we know that it's already based on heavy hiring from the government, because the unemployment rate now rose to 4.1% as more people entered the labor force and average hourly earnings cooled. This is a dangerous sign, because when you start to see average hourly earnings decline, it simply means there's more labor in the market that's available than employers need. Of course, that puts downward pressure. Again, you look at supply and demand, there's an oversupply of labor and a lack of demand. That puts downward pressure on wages at a time when most consumers and workers need to see higher wages to keep up with inflation. And average employment growth over the last 3 months slowed to the least since the start of 2021, reflecting a labor market that cooled more in the second quarter than previously estimated. Now, keep in mind, if we were supposed to be achieving this soft landing or no landing scenario, we should have seen it plateau, but indeed we're seeing it cool more than what everybody is expecting. This is just a trend in the wrong direction, but the data are consistent with other reports showing a sharp decline in job openings this year and a growing number of people filing for unemployment benefits. That is one of the biggest red flags in the market right now, but something that should be rising, well, should be your brokerage account. And I know you're thinking, Steve, this is a summer, there's probably no way to make money trading. I'm going to show you can make a ton of money, because it's not just the fact that oil keeps rising. And back last month on the 12th, we told our CTA Timer Pro subscribers to buy. We gave them the day to buy, the target that we've exceeded, their stop loss level, revised stop loss levels, and right now they're at 5.78% as of close of business on the 3rd. But that's not it. You want to make some money trading? Look at this. I pulled the report today, our CTA Timer Pro, where we look at the machine positioning and we look when machines are deep short and price moves against it. We have 10 open trades that we're tracking for our subscribers on the books. Every single one is up. We added 2 trades to the report today. Now, maybe you like to trade the technicals. That's our Momentum Timer Pro report, but we run a proprietary overlay, give you signals at different intervals, and have you all the tips to make those work. We have 9 open trades. 7 of those are up, but here's the big one. We added 11 trades to the report. You want to make some money? I give you 30 days and show you how to do it. All you have to do is click one of the links in the description below, sign up, and start trading and making money. Because when we look at the details here, it makes perfect sense that we have now a building oversupply of labor against a lack of demand for it. As we look at continued unemployment claims shown in blue against average hourly earnings of production and non-supervisory employees, we can see throughout history that as more people get on the unemployment line and stay on the unemployment line, well, that puts downward pressure on average hourly earnings. And this is something the government has highlighted and saying, look, we're giving workers, or at least encouraging employers, to provide ample pay growth to keep up with inflation, but based on the continuing uptick in continued claims, it says there's going to be further downward pressure on average hourly earnings. And if you'll note, the two of those tend to coincide with each other right at an inflection point or that of a recession. So you start to see the danger here for the U.S. economy that's coming in the summer. This is very unusual because a sustained slowdown in hiring combined with a recent moderation in inflation bolsters bets that the Fed policymakers will lower interest rates hopefully as soon as September. The jobs report is the last before Fed officials meet later this month, and we already know that the likelihood that the Fed's going to cut this month is fairly low unless something changes. But even the media now is starting to get behind the notion there's going to be a cut in September. And think about this, if we were indeed going to achieve this soft landing or no landing scenario, then what we would hear is the economy's about to rebound. There's no reason for a Fed cut. But now you're starting to hear more and more people start to realize the trajectory of the U.S. economy is not going the way the central policymakers want. And as we look at inflation, we can pretty much predict it's going to continue to head lower because when we look at total compensation, we now take average hourly earnings and multiply them by average weekly hours of production of non-supervisory employees. We put that in red on a year-over-year rate of change against the consumer price index, and we see a further slowdown here. That means it's going to put a ceiling on where inflation can go. The worst part is we have seen oil prices rise, and we know gas prices are rising as well, and that is putting a dent into consumer pocketbooks, suggesting inflation indeed coming down between now and September, perhaps giving the Fed all the information and data they need to cut rates. But hang tight, you'll see they're still in denial as of today. And what we can note is the downward revisions to the previous 2 months combined with a rise in the unemployment rate are significant data points. And one of the challenges right now is investors make their decision and policymakers on these headline numbers, and they turn to get revised significantly lower. Yet today we see, of course, investors driving stocks to new all-time highs under the belief the economy is strong, but perhaps they're finding out soon enough as the labor market is in far worse shape than they think. And this is what's changing here because we have some new data that really puts into question where the U.S. economy is going in terms of the soft landing scenario, because what it suggests is you're about to see is we're headed into an all-out recession. And wage growth is also slowing. This from Kathy Jones, the chief fixed income strategist at Charles Schwab. All that adds up to a slower trend that is not the direction we were told the economy was going to go. And now, of course, the central bankers are going to have to pull out all the stops to turn it around, but it'll be too little too late because the numbers may shift the Fed's perception of the balance of risk as unemployment increases against a backdrop of moderating inflation. Minutes from the central bank's June meeting showed a growing concern, this is important, that a further slowing in the economy will result in a higher jobless rate. Well, that's exactly what happens because employers don't keep workers around if they have no work for them to do, because employers need revenue. And if you don't have revenue to support your workers, it is cheaper to send them to the unemployment line, particularly when you know there is a lot of unemployed workers. Perhaps they're skilled workers that you could get at any time and even at a lower wage, perhaps, than you're paying your employees now. And here you can see the relationship between the unemployment rate that member Fed Chair Powell said was not going over 4%, now at 4.1, will make the case of why it's headed even higher. Because when you overlay continued unemployment claims, you see there's a very strong relationship between the two. And continued claims have started to tick higher and is now threatening to break out over 1.9 million claims per week. That would be dangerous because it's telling you the upside potential then of unemployment rate is going to continue to move in that upward direction in the months to come. By the time the Fed figures it out, it'll be too little too late. They'll start their cutting program and then start aggressively cutting as the entire U.S. economy grinds to a halt. The participation rate, the share of population that is working or looking for work, rose to 62.6%, which is historically not a large number. The rate for workers of 25 to 54, known as prime age, here's the key, increased to a 22-year high of 83.7, and that's a problem is because it's increasing into a marketplace where there isn't a demand for labor. That is going to again put further downward pressure on wages, and that means inflation all but a foregone conclusion to the downside. And in June, about 3/4 of the job gains were in healthcare and government. One concerning sign was the steepest slide in temporary help employment in more than 3 years. So even those looking for work that would take temporary jobs, well, they're not there. Manufacturing payrolls finally put a negative print in and decreased by the most since February. And we, of course, we knew this was eventually coming based on all the surveys in the manufacturing sector that said that indeed they were cutting employees. The government now getting caught up to that. But the figures won't help it in battle President Joe Biden, who is facing a growing number of calls from many Democrats to abandon his re-election bid following his disastrous debate with his predecessor, Donald Trump. Because as they made the statement, the labor market is key to re-election, and people are coming to the labor market looking for jobs, as according to the acting labor secretary. It is taking them longer to find them, but we're seeing a balance between supply and demand. Well, I got news for you, Julie. That's not going to last much longer, because even though you think it comes to workers looking for jobs and employers finding what they want, the reality is demand is going down here in a big way, and we have new evidence that confirms the U.S. economy is indeed about to head into recession. And what is that worst case scenario that's so terrifying is about to happen? The U.S. labor market's going to come unwound as the June jobless rate triggers a Sahm rule suggesting no soft landing, recession imminent. And this morning's U.S. Bureau of Labor Statistics data, the U3 unemployment rate increased to 4.1% in June, rising by 1/10 of a percentage point. And that means, of course, according to the rule, a recession is underway if the 3-month moving average of the national unemployment rate rises by half a percentage point or more relative to as low in the previous 12 months. With the June 2024 U3 rate of 4.1%, the average of the last 3 months being 4 and the lowest being 3.5%, the criteria has been met. The Sahm rule has triggered, and that means, as we've been suggesting, if people are losing their job and going on unemployment and are unable to find work because other people are on unemployment and can't find work, they stop spending money, and next thing you know, more people lose their job and get stuck on the system. And that's exactly what this real-time Sahm rule recession indicator suggests. I've drawn in that dotted red line, and that's the breaking point. And you can see going back all the way to the 1960s, when the Sahm rule breaks that red line to the upside, well, it means we're headed into a recession each and every time, this time on the back of the labor market coming unwound, which of course is what the political elite said was not going to happen. It wasn't long ago that they're telling us the labor market was strong and robust. Soon they're going to be saying they didn't see this coming, and it was completely unexpected that employers would be laying off. Surveys forecast the U3 rate to hold steady at 4 in June, but that little 0.1% uptick carries substantial implications for the broader economy. One possible confounding effect of the signal is growth in the labor force. If the labor force grows rapidly and the economy does not generate enough jobs to match the increase, which it's not, nor is it matching enough for those getting on unemployment, the unemployment rate might rise and the Sahm rule may be triggered even if overall employment is increasing. But the issue is the rise of initial claims over the past few weeks and 9 consecutive increases in continuing claims that we've been talking about support the June 2024 Sahm indication that indeed we are about to be heading into a recession led by a big decline in employment as we see more American workers lose their job, head the unemployment line. This means inflation is coming down. But again, for President Biden, this is not the news he wanted. For the Federal Reserve, who said we can achieve a soft landing, not the news we wanted. And for American workers that are indebted and already dealing with high interest rates and high prices, again, not the news they wanted. But will the Fed react? Well, they're in denial mode still today. As Fed Williams says, inflation job not done despite progress. Well, Williams, maybe you should call a Sahm rule up and see, because it's about to be over in a big way. As inflation is now around 2.5%, so we've seen significant progress in bringing it down, which is indeed true, but we still have a ways to go to reach our 2% target on a sustained basis. Note those keywords, sustained basis. We're committing to get the job done. The problem is the Fed is committed to sending the U.S. economy into recession and many American workers to the unemployment line. And with record amounts of debt and the banks already in a precarious situation, you can see we're now in the beginning stages of what will be an all-out financial crisis. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.